RUPEE'S architect, how India built its central bank in 1935. ***, midnight to 0:30, ***. One man. One document. One decision that would control the money supply of 350 million people for the next 90 years. On April 1, 1935, the Reserve Bank of India opened its doors in Calcutta with exactly 5 million rupees in capital, that's roughly $380,000 in today's money. A pittance. But what it represented was a financial coup so elegant, so calculated, that most people still don't understand who really orchestrated it or why. This isn't a story about independence. This is a story about who gets to control the printing press, and what happens when you hand that power to the wrong person, at exactly the right moment in history. ***, 0:30 to 2 o'clock, ***. Let's start with the official story. India, still under British colonial rule, needed a central bank. The British Raj had fragmented Indian finance across dozens of private banks, all competing, none regulated, all vulnerable to panic and collapse. In 1926, a commission led by British economist John Maynard Keynes recommended a centralized authority, a single institution to issue currency, manage reserves, and stabilize the financial system. Sounds reasonable. Sounds inevitable. Here's what the textbooks skip: Britain didn't want to give this power away. Not really. By 1934, as Indian nationalism accelerated, London faced a choice: grant India a central bank that it could theoretically control through colonial administration, or watch India strip the power from them anyway. The Reserve Bank of India Act was passed in March 1935. 1 month later, on April 1, the institution officially launched. Sir Osborne Smith, a British career banker who'd spent his entire adult life in the colonial service, was appointed the first governor. That's the detail right there. The man who would literally print India's money, who would set its interest rates, who would manage its currency during a global depression and a world war, was British. The board had Indian members, yes. But voting power? Structural authority? That stayed in London's hands, embedded in the institution itself. The capital was intentionally kept small, 5 million rupees, because if it had been larger, Indian investors would have demanded board seats proportional to their stake. This way, the institution could claim it was Indian while remaining operationally British. ***, 2 to 3:30, ***. Why did this structure collapse into something more genuinely Indian? Not because of principle. Because of World War II. When Germany invaded Poland in 1939, Britain needed resources. Fast. India's gold reserves, its foreign exchange, its rupee supply, suddenly, they all had wartime value. London began extracting wealth from the RBI at unprecedented scale. By 1945, India had financed roughly 20% of the entire British war effort, accumulating what we'd call sterling debt, essentially IOUs that Britain promised to repay after the war. Britain didn't repay them. Not meaningfully. But here's the unreported detail: during this extraction, Indian economists and civil servants embedded inside the RBI were taking notes. They were watching how currency supply actually worked. They were learning how to run a central bank without London dictating every decision. By 1947, when India formally gained independence, the infrastructure of central banking was already there. The RBI didn't need to be rebuilt, it needed to be reclaimed. ***, 3:30 to 4:45, ***. The real story isn't about the RBI's founding. It's about what the British thought they were building versus what they actually built. London designed the Reserve Bank of India as a tool of continued imperial control. They embedded British governance, limited Indian capital investment, and maintained decision-making authority in the hands of the colonial administration. But institutions, once created, develop momentum. They develop institutional knowledge. They develop people who understand them from the inside. By handing Indians the day-to-day operations of their own financial system, even under British supervision, Britain accidentally trained the people who would replace them. When independence came, those Indian economists and administrators didn't need to learn central banking. They already knew it. This reveals something crucial about power structures. The most effective way to control a system is usually through institutional design, not through constant surveillance. But institutional design only works if you maintain your position. If you lose power, the system you built becomes a weapon against you. Britain solved India's banking crisis by creating a central bank. But in solving it, they built the exact infrastructure that would make their control impossible to maintain once their power started eroding. *** for 45 to 545, ***. Here's the lesson that applies today: control of currency is control of power. Full stop. Every central bank in the world, the Federal Reserve, the ECB, the People's Bank of China, operates on institutional authority, not on raw force. That authority is only legitimate as long as the people governed by it believe it's legitimate. The moment that belief fractures, the institution becomes fragile, regardless of its reserves or its legal framework. The RBI was designed to be unquestionable. It was supposed to be so deeply embedded in British colonial authority that Indian independence would be economically impossible. Instead, it became the foundation of Indian economic sovereignty. The takeaway isn't about India in 1935. It's about this: if you're designing a system of financial control, remember that systems outlive designers. Build with the assumption that your successors might be your enemies. Because they usually are. This video is for educational purposes only, not financial advice.